Today, we are going to delve into Suncor Energy and see if this Canadian energy giant is worth all the hype. Fasten your seatbelts, folks. This is going to be a good one. Suncor is one of Canada's absolute energy titans who has a huge stake into, well, one of the largest oil sand reserves in the world. And that, of course, is the Athabascan oil sands. This important source of bitumen covers a massive 142,200 square kilometers in northwest Alberta. If we go back to 1967, Suncor made history as they were the first company to crack the code when it comes to extracting crude oil from oil sands. This was a game changer. Initially, the cost of extracting crude was too high to make it feasible, but as oil costs rose through the years and the refinement costs came down, it is a lot more practical. In fact, as long as oil remains above $60 a barrel, it is profitable. Today, Suncor is very much an integrated energy company. They have premium assets and promising growth prospects, and overall, they are laser focused on operational excellence. They are poised, without a doubt, to compete well on a global stage. Since they went public in 1992, they have upsized their oil sands output by an impressive 600%. This has translated into a return of investment since 1992 of 5,173%. Holy banana bread, that's not too shabby. Just to put that into perspective, the S&P 500 in that same period only did 373%. Join the conversation. Let us know in the comments if you already have any exposure to Suncor. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that click. We have talked about the oil sands, and that is a huge part of Suncor, but there is more. They also have 4 refineries that can produce 460,000 barrels a day. On their retail side, they own Petro-Canada, which has a network of more than 1,800 retail as well as wholesale locations right across the country. An interesting side note, Petro-Canada opened Canada's first electric highway, which was the first coast-to-coast network of EV chargers. As for renewable energy, Suncor owns and operates Canada's largest ethanol plant. They also have a couple of wind farms and have been investing heavily into biofuels, which is part of their greenhouse gas emission reduction goals. Renewable energy is still a small part of Suncor's overall business, but they have admitted that it is a priority to transition into a low carbon economy, and they do have plans to move in that direction, which is great. We have mentioned that they have been very profitable in the past, and that's fantastic. However, we are investing in the here and now, so despite how great this company sounds from their past, we need to take a fundamental dive into some of their current numbers. Now, to do that, of course, we're going to have to call on our good old buddy, Mr. Math. We'll start, of course, with some surface data. So Suncor has a market cap of $52.96 billion, and their beta comes in at 1.66, so they are fairly volatile. Their earnings per share comes in at a nice looking 6.12, and their price to earnings ratio comes in at 6.60. That's actually pretty impressive, as the average amongst oil companies is 14.30. When we look at their price to book ratio, that comes in at 1.30. And once again, the average with oil companies is 1.80. So this is really looking good. This is indicating right away that we may have a situation where this is an undervalued stock. When we look at their revenue comes in at $56.91 billion. Of that, the earnings came in at $8.18 billion. Now, they do have projected earnings to decline by about 15.3% per year. So that certainly raises one little red flag. However, we do have to keep this into perspective. These earnings have been growing at 15.8% per year over their last 5 years. These numbers can change with the price of oil pretty fast. When we look at their free cash flow, that comes in at $8.43 billion, and for return on equity, that comes in at 20.92%. Let's look at that fair value. I want to know if they are as undervalued as some of those numbers kind of indicated. So their current value right now is $40.39, and if you run a discounted cash flow model, you'll get a fair value of $48.74. That does mean, yes, they are undervalued by a good amount. 17.13%. And that is kind of what we were expecting. So that's interesting. Let's take a look at their returns. We'll start, of course, with their dividend. So they have a yield of 5.23%. That is paid out quarterly in the amount of 52 cents per share. The payout ratio on that comes in at 32.95%. So this is sustainable. And when I looked at their dividend has been consistently going up, which is another great sign. But at the same time, it's also a reflection on what's going on in the oil industry overall. Let's actually look at some of of the returns. Okay, we will, as normal, start with their 3-year. So their price rose from $23.02 to $40.39. That's a return on investment of 75.46%. Not too bad. When we add in the dividends, we get a total return of 94.53%. That is great. Okay, things look a little bit dicey though. When we get to their 1 year, their price actually did drop from $52.79 to $40.39. So their return on investment in the last year has been negative 23.49%. Add in the dividends, we get a total return of negative 19.64%. And this is, well, oil crashed big time in the last year. So this is very much in flow and in line with what's been happening to the overall market. In 2023, they experienced a little bit more of a drop, so they dropped from $42.73 to $40.39. That is a return on investment of negative 5.48%, a total return of negative 3.04%. This is very much in line with the market. Oil has been doing a little bit better in 2023, and when oil begins to pick up again, this is a company that will benefit from that big time, so that's always a factor to keep in mind when you're thinking about whether or not this is a good investment. So moving away from the returns, let's look at their debt. They have a total debt of $13.57 billion, and their total equity comes in at $39.95 billion. That gives them a debt to equity ratio of 34%. That's not too bad. In fact, this debt to equity ratio has come down from 38.7% just 5 years ago, so they are moving in the right direction. I would have liked to have seen them move a little bit faster, but we can't have everything we want, right? We also want to look at their cash and equivalents. They do have $1.13 billion sitting there in cash and equivalents, and that's important because it just shows that they do have cash on hand that can be utilized, well, if things were to go completely south. This is kind of a little bit of a safety net. Let's look at their short term. In the short term, their assets come in at $13.89 billion, and those liabilities come in a little lower at $12.54 billion. So that's not too bad. Their assets are definitely covering their liabilities. I like that. When we switch to their long term, their assets come in at $70.87 billion, and their liabilities come in at $32.27 billion. Once again, assets covering liabilities. I do like that. Their short-term assets, though, do not cover their long-term liabilities, and that's one of those other little things I like to see. But overall, it's still not that bad. When we look at their debt, it is well covered by their operating cash flow, and their interest payments on that debt are easily covered by their earnings before interest and taxes, or EBIT. Overall, Suncor's debt situation is not bad at all. I definitely can't complain about it, and they have a lot of room to weather anything the market wants to throw at them. So what is the final verdict? Suncor is a very profitable company, and they are never going to be a poor overall investment. They have deep pockets, room to take on more debt, and a renewable strategy that will serve them well as the market shifts to lower carbon. Just the fact that they are expanding their workforce when so many others are downsizing speaks volumes. However, this does not mean they are a perfect stock for all investors, or maybe they are. The short-term investor is not going to get their ideal return from Suncor, but at the same time, they will get a moderate dividend, and with patience, they will see returns on their capital. Suncor is a good total return stock, and once oil rebounds, they will have much more respectable growth returns in addition to their dividend. This is a solid stock pick for the mid to long-term investor, as the stock will get a chance to grow and the dividend will continue to pay you for your patience. This is a stock that will do well with very little doubt. So who is the stock not for? This is not the best choice for, well, a green investor. Suncor is moving in the right direction in terms of renewables, but nonetheless, their heavy reliance on oil sands will detour a lot of green investors. If they continue to develop and expand their renewables, this may win back some green investors, but for the greenest of the green, the oil sands may very well be a deal breaker. No matter how wonderful or maybe not wonderful this stock looks to you, be sure, of course, to do your own due diligence before you jump in, because when it comes to your money, you want to make sure that you put your research on the table. Keep the learning going. Watch my video on 100% Canadian ETFs linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.